Those of you that are just joining us, I want to welcome you to our webinar. This webinar series that we're putting on is about tax strategies. And one of the things that I have found over the years of doing what I do is that tax strategies are not always as apparent as they should be. So my name is Shannon Robnett. I am a 28-year veteran of the construction and development world. I'm only a 2.5-year veteran of the syndication capital raising world. But in my career, I've done over $350 million worth of real estate, everything from ground up to multifamily value add, all over the board. But one of the things that I figured out is that early on, the easiest way to get where you want to go is to breaker 1-9er. Oh, there he is. The easiest way to get where you want to go is to cut out your fat, ugly partner, Uncle Sam. And so I have spent a lot of time in my career spending countless hours reading books, going to seminars, and meeting people like Larry, who is a tax strategist, to make sure that I've done as much as possible to make sure that I don't have to pay Uncle Sam if I don't want to. And last time I checked, I still don't want to. So with that, I want to introduce the co-host of my webinars, Larry D. West III. Good afternoon, Larry. How are you?
Good afternoon. Good afternoon. I am doing well. No complaints here.
Why don't you go ahead and introduce yourself, and we'll get started. Then we'll introduce our guest for today and talk about the topic at hand.
Absolutely. Well, I think I'll cut straight to the point. I'm the guy that folks want to come and see when they are at the point that you just mentioned, tired of paying taxes.
Right,
to
exactly.
help develop strategies, ideas, insights on tax planning, proactive tax planning and tax strategy. Because as we know, and as we talk about quite often, it's not about what you make, it's about what you can keep. And we like to help you keep more of it.
Yeah, that's so true. And one of the things that Larry and I do very well together is keep me out of jail. So we talk about strategies that I like to employ. Larry does the research, make sure that we know the tax code that goes with that, and then implement that the right way, which is very, very important. But today we've got the pleasure of having with us Parker Pursell. Good morning, Parker. Afternoon, I guess.
Afternoon. Yep. 3:00 my time.
Yeah. So Parker, you are with a company that deals with tax strategies to a large degree. Why don't you go ahead and tell us about that and how your journey brought you there?
Yeah, well, that's a good question. So for me, how I came here to the eQRP is really not your typical route. I have a background in hospitality, went and graduated Auburn in 2013 with a marketing degree. Went to work with Chick-fil-A for about 2.5 years, got to travel the country with them, open up new locations, was pursuing to become an operator, and went back to my family business. We're in hospitality as well. We were a former, and this is a story for another time, but we were a former 115-year family fertilizer business, as you can see in the picture right there, now turned hospitality and hotel resort in Southeast Alabama. So I went back to help my dad on a $25 million development project. And then COVID hit. Obviously, 4 years later, I stepped out because I wanted to go learn some more skills, but honestly had no idea where I was going to go. So for about a year, I pressure washed and came across David and Damien, and through a friend of mine. And being entrepreneurial by nature, I just kind of I was just praying for peace during that time. Like, I just want to do something that's on mission to do something great, right? I want to help build. And so coming into this environment, I honestly didn't even know much about this world that you guys operate in. So I'm 2 years in, and I just feel like my mind's exploded. And it's great because I feel like I can meet a lot of the people that are out there looking for the things that you can offer them and what you've been doing for a long time, and really help communicate from their standpoint. Like, guys, like, you have no idea the information that's out there that can help keep more money in your pocket than you think you can. And it's all about the education and tools that you have. So me being here is really an accident, but I'm thankful I'm here.
Well, we're glad you showed up on time, and that was no accident. So we do appreciate that. You know, one of the things that I heard you say that you're talking about is, you know, the hospitality side of things and how you grew up in the traditional sense of how you make money. You
Mhm.
go to work, you get good at something, you make money, you pay taxes, you sleep at night, you go to church on Sunday, whatever it is that you do, it's a normal thing that happens all the time.
That was
And
me.
as Americans, we get so even as part of the, I don't know any nation that doesn't have taxes, but we just get so used to paying taxes. Larry and I spent the weekend with some people that are extremely high income earners that had tax bills that were in the seven figures, and they had just kind of accepted the fact that tax was part of their life. And Larry and I kind of looked at each other like, Shaggy and Scooby going, what? There's absolutely no need for this. How can we change this? And so one of the things that you're working with, Parker, you mentioned eQRP. Tell us a little bit more about what eQRP stands for and
Yep.
how someone gets involved with it other than, probation or something.
Yeah. So the EQRP is our own personal branding. It stands for Enhanced Qualified Retirement Plan. And what it is, it's a retirement savings trust is its legal formation. But what it does is it gives you complete control over your retirement. So those that are individuals that own businesses, or you're a small business owner and you have employees, this can serve both. And it's the only product out there of its kind that allows you to take complete control as an individual and a business owner. And so really what it is a tool, right? When you start talking about these alternative asset opportunities that you can get into, right? A common thing that people come back with is, well, I won't get to realize the tax depreciation or whatever it may be. I'm like, I hear you, but do you have a tax problem, right? It's like you're focusing on the wrong thing first. And looking at a retirement plan, if you're going the traditional route, is really honestly probably not the route you should go, giving your money to Wall Street, letting them do what's happening right now, right? So with something like this, you have the ability to escape and then go put that money into syndications and other alternative assets, being real estate, crypto, gold, silver, you name it, private placement, hard money lending, and everything you make back is tax deferred or tax free. But the goal is to be tax free. So if you have a Roth entity set up through a business that's generating you a lot of income, let's say you get to the end of the year and you're like, oh shoot, I've got an additional $100,000 I made, I need to go hide somewhere and I don't have any deals, then this is a great tool for you to drop that money in and then go make all your returns tax-free in these deals passively. So I'm pretty passionate about it, but I could run down a rabbit hole with you.
So Larry, let's go back and let's talk about the tax codes that work with what Parker's talking about, because that's what we really want to do is unpack how this happens. And kind of, he said words that I like hide money, right? He said things that
words
that
that give me anxiety.
Yeah.
Exactly. That's what keeps Larry up at night, is going back through these videos and sending me a list of words that I'm not supposed to ever use again. So Parker, I'm really grateful that you're bringing these up for Larry. But talk about what it is Larry's or Parker's talking about and what that vehicle means and how one can use it in their life.
Yeah, I think to boil it down into simplest terms, a lot of us who are familiar with our day-to-day 9-to-5 W-2 jobs, typically our employer offers us a 401k with some matching provisions and all those things. And however, some people give a great deal of thought, some people don't think about it at all, but a lot of folks will contribute to the 401k. And the number one reason they do so is to lower their tax bill in the current year. You put your pre-tax dollars into the 401k, that reduces your W-2 salary, which lowers your tax. And there are other iterations there. But what tends to happen is as you go throughout your life working, that pot starts to swell. And by default, a lot of that money goes, as Parker pointed out, to Wall Street by way of mutual funds and all those different kinds of investments. What he's suggesting is, great, get your tax deduction if you want to put those pre-tax dollars in. But now we have a vehicle that gives you the opportunity to not have to go to Wall Street. let's go look at real estate. Let's look at crypto or some other type of alternative investments. So now not only do you get a tax deduction, but now you get control over where your money goes, and that money continues to grow tax-free. It's still a qualified plan. So that's definitely a win there.
Yeah. People come at us and say like, this sounds too good to be true, or are y'all sure? Is the IRS like allow this? And we're like, yeah, I mean, we've got our letter of determination from them. So it's all about the education piece. So just like you said, if you don't know, you don't know.
And so Parker, let's go back to what Larry said and bring this back around. You know, a lot of people have 401ks. A lot of people have IRAs, traditional Roths, things that they did set up at their employer.
Mhm.
Can they move that into your product? And are there advantages when they do that? What's really the difference?
Yeah. So IRAs are retail structured, meaning that all you have to do is have a job, right? Doesn't matter where you work. You just have to be making income and put money in. So, and the limits are really low. So you're looking at $6,000 to $7,000 a year. And if you go with a Roth IRA, it's locked up forever. You cannot move it into a 401k structure. So typically the people that come to us are that own businesses, right? They're a solopreneur or they're a small business owner, or they have old 401ks from previous companies they worked at, traditional IRAs. So all those can be moved inside the plan. And we help those individuals out. So the benefit for them is, you know, they can take that over, right, and then just go put it to work. But with the contribution limits being much higher, you can put in up to, I want to say this year's like 61.5, something like that. Correct me, Larry, if I'm wrong. So you're the employer and the employee. So you can max out your deferral. If let's say you're a consultant, right? You could put the 20,500 in, defer, and then you can profit share to yourself up to that 61,500 for the year. And you can do Roth or you can do tax deferred. So there's a lot of options for you inside.
Now, take a second, hold on there. Take a second and explain Roth and tax deferred. I mean, they seem kind of obvious with the second one, but the first one, why not just call it pre-tax?
Pre-tax. Yeah. It's just,
why do they call it Roth, right?
Yeah. Pre-tax Roth.
Okay.
Well,
And so you're putting your funds in.
Pre-tax and Roth aren't the same. So pre-tax is you not taxed on that money now, and so you get taxed on it later when it comes out. The Roth is post-tax or tax deferred, or let me say it this way. Actually, the Roth is you pay taxes on it right now so that it grows tax-free, and you don't pay taxes on it later.
Okay.
So if you think your income taxes are going to be lower or equal 20, 30 years down the road, wherever you're at in your retirement age, then, you know, you wait. But if you're not confident in that, which most people aren't, you go ahead and pay the taxes now and invest that tax-free.
And really, Parker, my bit of advice that if you think taxes are going to go down in 30 years, you need to start selling what you're smoking. You'll be a lot more profitable because, you know, the reality is, look, we can't fund the world that we've created politically. Doesn't matter what side of the aisle you're on. You can't fund the 40 billion we just sent to the Ukraine on a lower tax rate, right? I mean, you just can't do it. So I think a lot of people, and I had this conversation with a surgeon the other day, 2 weeks ago. And I'm at that age where the other day can be anywhere in the last 3 months. But the thing that he had done is he had done something exactly like this. He put all this money away, was now faced with that conversation that he's having with himself of, this is now coming out. I'm 65. I'm taking distributions and I've deferred the tax until now. And the tax is much higher than when I started. I wish I'd have done something different. Right. And so I guess I'm saying that to say that oftentimes smart people miss the nuances and miss what it really means to look at what the future holds. They're just looking at, well, I'd rather pay 35% of $10 million than 35% of, 80,000 or whatever it is. It doesn't, because it'll grow faster.
And Larry, you can agree with me on this. It's kind of like dollar cost averaging out, right? But from a tax standpoint, if you just start today paying in your tax bracket and go ahead and building that snowball of Roth dollars, then over time, when you get there, right, you're going to have a much bigger snowball of Roth money that's being invested tax-free than at a later date, you're potentially paying a much higher tax bracket. And so that's really my advice. It's like, if the goal is to get to zero, just go ahead and get to zero now if you can do it.
Right.
Yep.
So staying in that vein, so we've now put our money in the eQRP route. We've gone that way. We've put in the 62,000, and we're assuming that in order to put in that 62,000, our business has to have made at least $62,000, right? We can't contribute to ourselves to the deficit of the company into a negative position. Once we know that that's happened and we've grown it like this surgeon, we're going to assume he was in this eQRP program that you have. What are some of the strategies that are tax efficient for his exit?
So
You just walk up and pull it out and pay the taxes and let it rip?
yeah, I mean, there's a lot of ways that you can maneuver income tax, right? Like if you've got, there's like a really unique play if you're a real estate professional and you've got bonus depreciation. It's really unique, actually, is that you can take your bonus depreciation, and if you wanted to convert to Roth out of your retirement plan, let's just say you had $100,000 bonus depreciation that you could realize, and you wanted to convert 100,000 of your plan to Roth, then that event would negate itself, right? So you're not going to pay taxes, which people don't know that. But for him, really the only strategy is to maybe pull that out during the year and go put it in a tax advantaged investment, right? There's a lot of them out there, but he's got to have enough income to support himself, right? So it really kind of depends on what his strategy is with that money. So a lot of people, even with their retirement, when they start pulling from it, they're trying to generate maybe some more cash flow for them. But what I love about people being at this state is if you're close to retirement and you have a plan like this, you can actually earn your income in a tax advantaged way, right? You can either be earning your income tax free and you're just drawing it out, right? Or you're just paying income taxes when you pull it out. So it really kind of depends on his situation that he'd be doing.
So Larry,
Yeah,
let's expand
Parker,
on that.
Oh, look, we were going in the right direction. It's exactly where I was going. So, when you examine that, I think Parker made a couple of key points. I want to make sure it's not lost on our viewers here, especially with respect to tax-free cash flow. When you think about traditional versus Roth, we just broke that down, pre-tax versus post-tax. If you can stomach the tax bill now, which most of us agree taxes are going up in the future, so paying at a lower rate now makes sense, go ahead and consider or look at the Roth contribution. Because once you can get the Roth money into a plan like this, you go and do a syndication deal or whatever type of investment, it grows tax-free over time. So now we've got growth that nobody's paying taxes on. And now when you get to retirement age, like the surgeon, had he or she done a Roth, they can now pull that money out completely tax-free. They bit the bullet and paid taxes on it, umpteenth years ago, presumably at a lower rate. Now they're at retirement age. They got this big chassis, this big nest egg, because they've used that money to do different deals. Tax-free money comes out without issue. There's no unique strategy you have to employ or anything like that. This is just the tax rules and how it works. Now, on the other side, let's say you did the traditional because you wanted the tax break in current day. So when you take this money out at some point down the line, you got to pay taxes on it. Well, Parker just lined up a great scenario, especially if you're in the real estate space. If you can qualify for real estate professional status and some of those other unique strategies that come into play. Well, now you've got a chassis of money. You can pull out, let's call it $50,000, or Parker's example, $100,000, and you go do a deal with Shannon, and it provides $100,000 of bonus depreciation. Well, you just pulled out income. You got a deduction that then comes to you completely tax-free. So it's all about strategy and planning and timing. But when you use these different kind of strategies, you can build tax-free cash flow and wealth.
So Larry, real quick, what is considered to be a real estate professional under the IRS code?
Yes, so there are three unique things folks have to do. Number one, primary occupation has to be in real property, trade, or business, which essentially means more than 50% of your time has to be somewhere in the area of real estate, development, property management, sales, investment, what have you. Number two, you have to spend at least 750 hours in real estate related activities. So 750 hours, more than half your time. And then the last one, this is the most important one, you have to materially participate in your rental related activity, which basically means you got to do some work, right? And you got to do more work than anyone else in your specific real estate rental business. The combination of those three opens the door for you to qualify for real estate professional status, and it opens the door for an opportunity for your real estate losses, like we just talked about, to offset your active income.
So what I heard you say, Larry, is that 750 hours is probably the biggest thing, especially if you're retirement age, which is, I just did the math real quick. It's 14 hours a week. You have to spend 14 hours a week collecting rent, checking on your properties, talking to realtors, whatever that is, to qualify as that real estate professional. The other thing is that the majority of your income would have to come from that.
Time, not income, majority of your
Okay.
time.
Okay. So if you had a JOB that was paying you 250, but you were spending 14 hours a week doing this, it would just need to mean that you couldn't spend 18 hours a week in your other profession generating the other money.
Yes. Yep. That's
Okay,
right. That's right.
great.
And so tracking those hours is really, really important because that's going to be the saving grace if an audit
Sure.
ever shows up.
So when you're offsetting like that, that's important because now you've grown that money tax deferred. And now when it comes time to actually do that, which is exactly what we're doing with this surgeon in this particular instance, is we're putting him into a large scale development that offsets like that so that he can then have those returns without that tax problem. So when we're looking at that, we keep talking about the Roth, Parker. What is there any difference other than the dollar amount that you can put in? Is there any difference when you're leaving the investments, when you're cashing them back out and spending the money between the eQRP and the Roth or the traditional self-directed IRA?
Yeah, there's actually a big difference. And a lot of people, like I said, don't know about this because most people in this space, when you think self-direct, they think, oh, self-directed IRA. That's like, it's just been marketed to them that is what you invest in real estate with. But what's not told to them is that debt is going to be against them and they're going to get taxed on the portions. So let's just say you have a deal that's 60% leveraged, right? Or 70% leveraged. And that deal matures. Then on the exit, if you're using a traditional IRA or just an IRA in general, Roth IRA traditional, you are going to get taxed your profits equal to the amount of debt that was used. So if 70% was leveraged, then 70% of your profits are going to be taxed up to 37%, which when you think about that, they're like, well, why would anybody ever do it that way? Why would you? That's the question. You just ask it back to them, right? So it's another way to keep your money instead of paying, most deals out there around, $50,000, $100,000 that you get into anyway for these investment opportunities. And you could be paying, $20,000, $30,000 in taxes just back to Uncle Sam. And instead, if you did it in a 401k structure, they're not subject to that tax. So debt is your friend inside of a 401k. It's not in an IRA. So then you can keep that money in your pocket, like we talked about, right? And then go put that towards another opportunity that can, in perpetuity, gain you, whatever returns you're looking for.
I think I got most of that. So what I guess I don't understand is why Uncle Sam would treat the IRA different than the 401k. Larry, you got some insight on that?
Yeah, I think to put it plainly, 401ks, for all intents, are considered somewhat of a trust account, right? And trusts aren't subject to that UBIT tax that Parker was just referencing. And so that's really the main difference there on why the IRA is likely subject to UBIT and the eQRP 401k is not.
Okay. So then that rolls into, if you're doing it that way and you're not worried about the UBIT tax because you've done it in the 401k format or the eQRP, how does that help you avoid capital gains tax and other things like that, to where you're able to grow this? Okay, so I like it when people invest with me. That's always part of our syndication business. and they come to me and they've done it in their eQRP, and we're now handing them back their profits. What about this setup helps them with their capital gains tax?
I'll just let you answer that one, Larry, because you're the tax guy. I can give my answer, but you can put it to them in a real way.
Yeah, absolutely. So remember, these are qualified plans. These are tax advantage plans, and the government is trying to incentivize you to save for retirement. So they tell you, if you put your money in this account, the growth on that account we will not tax, right? And until you get to the end and you take it out, if you did a traditional or if you did a Roth, you already pay taxes on that money. So we're going to allow the growth to happen tax-free. So any transaction that happens inside of this eQRP style account, or even your IRA account, doesn't get hit with any tax implications right away. So you said if it's crypto, you sell crypto, no capital gains tax. You have property, you go sell property, no capital gains tax. And that's why it was important when we were at the beginning talking about traditional versus Roth, because think about that for a moment. If I take this $60,000 and I pay the taxes on it today, I've got to send the IRS $20,000. Ooh, that's going to hurt my heart. I get it, right? But I got $60,000 in this account. I go do a deal with Shannon. He gets me 2x my money. I got $120K coming back to me, $60K of my real money, $60K of my gain, and I don't pay taxes on that additional $60K. Imagine if I did that outside of the retirement account. Not only did I pay taxes on the first 60, but when that capital gain happened, I pay taxes on the additional 60, plus some depreciation recapture and a bunch of other things. So this is a very unique tax advantage way to grow that pot and not pay taxes on the growth along the way. So long-winded answer, but I hope that got to the point.
I think it's important. Now, my pragmatic mind, Larry, says, okay, yes, you avoided a 20% capital gains tax. So on the 60, we grew at 60. Now that's coming back to you. You would have paid, if you did capital gains, you would have only paid 15, right? 20%, about 18. And you would have paid that now. 20 years from now, you're going to take that out of your 401k to yourself as income.
No.
You could be in a, no.
And the example we just talked about, we did a Roth. So when I got paid $60,000 from my job and I put it into this Roth style account, I paid the tax on the $60,000 in today's time, 2022. So I went ahead and sent the IRS my check.
Okay.
And then I've got 60 in my account. I do the deal with you. It grows. And 20 years down the line, when I take that 120 out, I don't pay taxes on any of it because I simply sent the check 20 years ago and bit the bullet way back then.
Right. So Parker,
Well,
let me just hop in here real quick. So the eQRP is a Roth type program.
it has a Roth component built into it. So you can have both pre-tax and post-tax Roth dollars in here. So the plan allows for you to have both inside the plan.
Got it.
And I just want to hit on something real quick that Larry was talking about. So retirement structures, when they were created originally, let's kind of like go back and think, what was the environment like? Where did that money go? Why did they incentivize us to put it in there? Why did they say you can't touch this until, they'll lock your money up for 20, 30, 40 years? It went straight to Wall Street, right? So it benefits them. So it's a way for Wall Street to get more money, for them to get paid more. I mean, it's a big cycle, right, of how the politicians and everything work. So when you have accounts like this or programs like this that allow you to escape, that's why you're seeing the friction that you did at the end of last year, where Congress was trying to eliminate self-directed IRAs because there's trillions of dollars investing in Main Street, and Wall Street was losing out on those trillions of dollars. So that's why they were making it more. There's more friction in the process for you to, control your money or put it in these alternative assets. So it's like when you actually take a second and think, like, why is there so much friction for doing it this way? But then when you want to go this way, it's like the easiest thing that you can do, right? So,
right. Well, and that's where, Larry has spent, literally a lifetime, and I've spent quite a bit of time trying to figure out the way to read the tax code as the incentive code, not the penal code, right? Because you keep banging your head against the wall and go, man, why won't they let me do this? Why won't they let me do this? I just sent Larry, we had a conversation on Monday about how to write off a Ferrari. And I sent an article to Larry so that we can figure out how. I don't know that my wife will allow me to live through that experience, but it would be a great exercise to be able to say that you could do that and finding the structure that would allow you to do that instead of looking at it going, well, it doesn't weigh 6,000 pounds, so you can't write it off. But that's just one way that this applies. So Parker, I really appreciate you jumping in here and helping us understand better why the eQRP is in a lot of ways better than a Roth. It's got better components in it than a traditional self-directed IRA. It's got a lot of things mixed up in that. And before we close out and go to question and answer time, is there anything else that we didn't hit on that we should be talking about why the eQRP program is such a good program that is so vital for tax-free growth and or tax deferred in the right circumstances and areas?
Yeah, I mean, I think Larry hit on a bunch of really good things, and I'm glad that your expertise was here to really help break some of that down. For me, I think the two things that the reason we exist as a company is to help people achieve two things, which is more certainty and more variety. So an individual who is seeking investments that they can be more certain about, right? Things that they can touch, they can walk up to, they can control, and they have variety. They have more options that they can go jump into other than just being stuck within the stock market. Just as we're seeing right now, people in traditional structures of retirement are just on this roller coaster of hoping and praying that it goes back up. But someone with a plan like this, even if they were in the stock market and they saw it start to like go down, they could pull and then go buy silver and gold if they wanted to with no tax implications, right? So
Right.
The ability to be agile and move and meet kind of the market as it's riding out in its crazy ways is important. And people are seeking those things as they get older. They're looking for more variety. They're looking for more control and certainty. And that's what we want to give people. And we're just here to help them do that. So we're not telling them what to do. We're only telling them how to do it. So
Yeah.
that's why
and
we're
that's
here.
important. So we got a question here. What is the official IRS designation of this wizardly product and structure? And what is the IRS code that governs it? So when you're talking about the eQRP, what is the designation and the official structure that governs it?
It's in section 401 because it's a 401k. So
I love
I've
that
got-
about the IRS. You want to do a 1031, look in section 10.
Yeah. Well, I can send that individual our letter of determination that kind of writes out like who we are, what we do, but it's in section 401 and a couple other variants because we have the ability to adapt, right? So business owners in their current structures that they're in cannot self-direct their retirement, but this plan allows for them to control their investments. And as they're stuffing this money away, right, to help mitigate their tax liability, they now can go invest in some of these other alternative assets that they feel more certain about, and they have other variety to get out into than just Netflix, Apple, Google, Disney, those things.
Awesome. And then we will make sure and get that determination letter out to all of our guests and attendees today. We've got another question. To clarify, I can transfer all of my old 401ks, my SEP, and my old Roths into an eQRP? Question mark.
Yeah. So the only two accounts that cannot move into an eQRP or just a 401k in general is a Roth IRA and an inherited IRA. But you are correct. You can transfer any old 401ks, SEPs into the eQRP, and you can use those to invest in passive investment. So you can invest with Shannon. You can go buy gold. You could go buy crypto. I mean, you could do anything. As long
So
as it's
then
qualified.
the second part of the question, this is 2 of 3 parts.
Mhm.
Then I can use those funds to purchase investment properties or invest in syndications freely with those funds, basically checkbook control, correct?
Correct. Yep.
Okay. Then if I sell
Yeah.
that property,
One caveat there.
This is why I don't
Send
like
it.
having Larry on the show.
So syndications, great, fine. You're passive. Fund manager, property managers, they're doing the work. But Parker, correct me if I'm wrong, with these type of accounts, when you go try to buy your own property, right? Let's just say you go buy a single family, you are not allowed to do work on that single family unit. You need to hire that out or have a property
Correct.
manager or something of the sort, because you cannot directly benefit from those funds, right? Am I right in that direction?
Everything has to be passive in nature. So if I had my retirement money, I give it to Shannon. He's going to do all the work. When people want to get into the single family space and rental, it gets gray only because that environment, most people that are in it like to be hands-on. So you can't do that. It's disqualified, but you'd have to get a property manager, contract out all the work. You can't be actively involved with an investment like that. But so passive in nature, I like to say arm's length distance from anything you invest in.
Okay.
So, correct. That's a good point.
Then the last part of the question was, if I sell that property or that the syndication sells, what do I have to do with those proceeds? Don't I
So
just pull them back into the 401k account?
Everything that you send out from your retirement plan goes back into your retirement plan. So you can't take money back out into your personal bank account, or that'll be considered a distribution. And if you're not at the age of retirement yet, there'd be a 10% penalty on that. So everything you invest that goes out comes back in.
Now it's a 10% plus any taxes that would be due, correct? Okay.
Correct.
Now, for clarity, Celia asked, if I am a real estate professional, does that make a difference with the self-management?
No.
Okay.
That applies across all retirement plans.
Now, to clarify, not only can Celia transfer all of her old 401k, SEPs, and Roths, she can also transfer her husband's.
Right.
Because I know Celia and I know her husband, and I know that he's smart enough to let her do it, just to make things simple.
Right.
So,
Yep.
One of the other questions that I have too is, Parker, can I loan money?
Yep.
I don't want to buy something. I don't necessarily want to get involved in a syndication. I just want to loan the money out. Can I do that with my eQRP?
Absolutely. You could say, I could be like, Shannon, I got a fix and flip I need, and I need, 70 grand. Can you loan me that? You're like, yep, I'll give you. And we write the terms up, right? So it's between you and me. You say, Parker, I'll give you a 70 grand over a 6-month time frame at 18% interest. I'm like, good. I sign it off. You make 18% on that 70 grand. It goes right back into your account.
And that doesn't
Tax-free.
necessarily have to be on real estate.
Oh, it could be anything.
Okay. It just has to be arm's length. I can't do this for my kids for a down payment on their house.
Correct. You can't do that. So think vertical and horizontal. So anything investment wise that you're doing can be done from a horizontal standpoint. So your brother, your sister, your aunt, your uncle, you can get in investments with them, but you can't do anything that's vertical in lineage, being parent, spouse, child, grandchild. So it's
some
really
of y'all from the South might want to check.
What'd you say? Oh, hey, look, I'm not an Alabama fan, so you don't have to worry about that.
I couldn't help it. This is why I give Larry more anxiety than he needs, because I say comments like that. But I come from Oklahoma, so we always question at the family reunion exactly how you're related. So we're clear. But the other thing that I really like about that, though, Parker, is because you can have that true checkbook control. You can, in an eQRP, go from real estate to stocks to crypto to gold and silver to exotic cars if you'd like, as long as there is a way for you to show that you actually made the purchase, that the funds actually went out. There's a lot to that. But if we're doing all this moving and going around and everything, how do we keep all that documentation clear?
Yeah, so this is I say the biggest drawback to a plan like this is the advantage. So you do have to be organized by nature with what you're doing, because you control all the investments, right? So And everybody has their own systems and how they do it. Whatever works for you may not work for someone else. So typically with your retirement plan, you're not treating it like a business. You might do 5 to 7 transactions a year, maybe. And that seems like on the high end, right? So you'll send 100,000 out to a syndication. You may loan out 50,000 to someone, and you'll ledger that, right? So as money comes back into your account, you have your digital ledger of where money's coming in, where it's coming from. So in the event an audit happens, you have all that there, but you just come up with your own system, and we can help people create those and brainstorm through what works best for them. But typically you aren't going to see someone doing, 30, 40 events, because the IRS, that would raise a red flag, and they'd be like, is this dude running a business out of here? And you just don't want them. If smoke's coming up in your camp, they're coming after you regardless. So,
Right. So make it one big transaction is what I heard you say.
Yeah. And it's passive in nature, right? So you're just
Right.
throwing your money out, letting someone else do the work for you. So,
Right. Well, let's see, we got a couple more questions here. Jacob is asking, what are the qualifications for the fiduciary? And I think we just kind of went through that, but would you guys get a little bit more granular on what that fiduciary means if I am taking care of that track record going in and out?
do you want to answer, Larry? Or do you feel comfortable, or you want me to answer?
Yeah, I'm going to toss that back in your court.
Okay. Yeah. So, with IRAs, there's fiduciary responsibility of the custodian to have documentation, keep up with all that stuff, right? They're doing it for you, which is why they're feeing you, why they're paying you, or you're paying them. With a plan like this, you are the trustee over your plan. We are not considered fiduciary oversights of your plan, right? We help coach people with their money, but we don't see what people are doing on a daily basis. So the onus falls on you as the owner of the account, as the trustee, because you're acting on your own behalf, right? So as long as you're keeping good documentation of what's going out, you can work with your CPA. There's a lot of people that bring their CPAs into the fold to help them keep things organized. And so I would say that when you say fiduciary, that falls with the eQRP on the individual, not anybody else.
So to clarify, if I'm with a self-directed IRA company, they act as my fiduciary. They
Correct.
title in their name. They're the independent. They're the go-between. So if I were to go buy a house we're just going to make it a cash transaction. I'm going to go out and I'm going to buy $100,000 house. I go out in a self-directed IRA. The self-directed IRA takes title of that house as Shannon's self-directed IRA. In your world, Parker, in the eQRP world, I go out, buy the house, the funds come out of my self-directed IRA. I keep a ledger as to what money went out, where it went, but it's not necessarily titled in anything special's name. It's not you eQRP guys are not.
So it's in the name of your plan. So we'll use Larry, for example. If he had an eQRP, we'd say Larry West eQRP 401k, or we have LLCs we build inside of our plans for asset protection when they're investing outside of the market. So it's a single member LLC. It's a disregarded entity. So it's not conducting any business activity because the money that's being used is retirement money. So the IRS doesn't deem it as, business activity, quote unquote. So that LLC then takes ownership, right? So it gives you anonymity and that corporate protection. So whatever you name that LLC is the owner, but your retirement plan owns it. So you can use your eQRP if you want yourself exposed, or you can use the LLC that we create for you to give you that protection. But you have total control over that.
And just to add a bit of further clarity there, Shannon, self-directed IRA or eQRP, neither of those situations is the company, the respective company, going to be that fiduciary that I think the question is implying. As Parker mentioned, you as the investor, the onus is on you for proper record keeping and reporting and documentation. So you work with either yourself or your CPA to make sure you have all of that stuff lined out. The key difference is EQRPs give you far more control over what you invest in as opposed to some of the other ones, and they have limited exposure to UBIT tax.
Okay, so now I'm going to skip Jacob's second question, ask his third questions. Is the custodian, the EQRP, bonded, and what is their incentive for participating in this plan?
What do you mean by that when you say
Well,
bonded?
we understand why an IRA is involved. They charge a fee, they charge a management fee. You know, they get paid along the way. What is the incentive if I have so much control and I don't really need you, right? I mean, if I buy something and put it in my IRA, there's somebody there that does all the work and puts all the papers together and asks all the questions and really does a lot of CYA on my behalf.
Mhm.
I'm paying for that. What is your incentive, number one, to be a participant of this and to help people do this? And number two, is there some sort of custodial bonding and assurance that we're doing it right and we're covered?
So I think I know what you're asking. So for us, the friction of getting something like this set up, getting assets moved over. So let's say you have syndication investments in your IRA that you already have that are exposed to that UDFI UBIT tax. We're going to do all the work in re-registering those assets. We do this on a daily basis. So we step in, we're going to set the accounts up for you. We're going to do the legal documentation of creating the plan for you. We'll file your 1099s, 5500s each year for you. So we honestly do all the heavy lifting in creating this product. So we're going to get you from A to Z as quick as possible. And then think of us like when you buy an Apple product, we're like the Apple Genius Bar. We're there if you need us, when you need help, when you need support, when you have how questions, that's where we step in and help. So you have people that enter our community that, know a lot and they're super sophisticated and they just run off and know what to do. And then you have people who don't really understand, or this is their first time engaging in something like this and they need help and hand-holding. And that's what we enjoy doing. So when you start saying what's in it for us, it's really missional, right? So when we have people like myself, when I came in, it's like, wait, we do all this? When people perceive your value to be greater, when they look at us and say, are y'all financial advisors? We're like, no, we're not, but we just understand the 401k structure well. We're going to do all the work for them. They perceive us to be much more, which is great because that's what we want to be. And then on the back end, we're just here to help make sure they have clarity on, is this qualified transaction? Is it not? And then if we don't know, we're going to find an answer for you. So
Perfect. Awesome. That's great. And then Jacob had one last question, or in this series, have there been any guides to use this with NFTs? Because you can buy anything, I wouldn't think that an NFT would be particularly disallowed.
Yeah. So Larry, I don't know what you're.
Oh, look at that. Look at that.
Yeah.
We got some shuffling.
No, I'm going to go and give my take.
Yeah.
It's gray. So because there's no regulation in the crypto space, you can invest in Bitcoin, you can invest in any type of cryptocurrency, but when it comes to, you can't invest in collectibles. NFTs are, I would deem as a collectible. Is there any language saying that you can't invest in NFTs? No, but my thing is if it's gray, stay away. So that's if I say I give advice, that's the only advice I give. If it smells, there's a zillion other things you can go invest in. Go put that money there and don't give the IRS a reason to come after you.
Okay. So then Celia's got another question. So I would just give you copies of all my accounts and you would bring them all into my eQRP and set them all up.
Correct.
And then I'm sure that once we have established what it is I have to bring, you would then set a fee as far as what that would cost and what that would take.
Mm-hmm.
And we've got another question there that says, what would that cost? I'm sure that that's more of a case-by-case basis, or do you have a general cost that you can throw out here that we can nail your feet to the floor on?
Yeah, I mean, it's a case-by-case. So if you're a business owner with employees, it's different because we have a third-party administrator we bring in. It's a little more complex for businesses. So for the sake of individuals, it's going to be a little under $5,000 to get everything going, but we're not a fee-based company. It's very black and white. So we're going to do all the work for you on the front end, right? We're going to get those accounts set up. We're going to get those assets moved over. It'll be very light work done on your end, basically just, putting your name to the signature because we can't sign for you, right? And then each year it's going to be anywhere, little under $600 to get everything going, depending on where you want to enter. We have some different, options for you, but it's fixed. So as your account grows, really your annuals get smaller and smaller and smaller. So there's no
As far as a percentage basis.
Correct. And
Yeah.
And we have a bank that we work with that doesn't have any wire fees as you send your money out. So, we're here to make your life and the easiest it can be with a self-directed plan, and also give you something to where, to be quite honest, you're not going to want to go anywhere else because you can get it all here. And we want you to have that.
So one of the things, guys, I want to thank you both for showing up and being experts on our panel here. I want to thank you in the audience for giving us such great questions. We are going to send out Parker's contact, his personal cell phone number, so you can call him day or night. No, but we will get you that contact information as well as a copy of the recording here, so that you can kind of go back through it and see what you need. But then you can contact Parker directly. You'll also get Larry's contact information. So if you've got some particular questions, one of the things that Larry and I love to do is work together. Larry is all about taking your last couple of years' taxes, reviewing what you're doing, changing that moving forward so that you can get to that tax-free cash flow as quickly as possible while reducing what you pay the IRS, increasing what you can invest, and getting you to your goals quicker. So Larry's got a program that he can definitely help you with that. So you're going to get both of those guys' contact information. I really want to thank you all for showing up for the tax-free cash flow. We've got another one of these coming up here in a couple of weeks. But guys, do you have any closing words for anybody, or any closing thoughts before we jump off here at the top of the hour?
Shannon, I don't know how you close much better than what you just did.
Well, I got 2 minutes and another one to go to, so I had to get it done. So, guys, I really want to say thanks, and we will be talking with you all again soon. Thanks for joining us on Tax-Free Cash Flow.
See you in a couple weeks.
All right.